All right, thanks for bearing with me as we switch gears from investing to the statement of cash flows. The statement of cash flows is the fourth and final financial statement that we learn about in this course. And what this statement represents is the amount of cash that comes into and out of the business. Uh, and I'm going to show you what this looks like, how the statement of cash flows is made, and I'm going to show you all the information that you as a manager can get from it. So I'm going to show you how the statement of cash flows is organized, and it'll help you make good decisions as a manager based on the statement of cash flows. So the statement of cash flows shows all the cash coming into the business and out of the business during a particular accounting period, usually 1 year. These cash flows are separated out into three different categories. The first category is operating activities. Operating activities represents the day-to-day operations of the business. Things like receiving cash from our customers for sales that we've made. That's cash coming into the business for operating activities. And cash going out of the business for operating activities would be things like we're paying rent, we're paying our employees, we're paying our utilities, we're paying our accounts payable, we're paying interest expense. These are all operating activities. The second area that the statement of cash flows is broken out into is called investing activities. The company sometimes needs to grow and expand. How do we grow and expand? We purchase or sell property, plant, and equipment. We call that investing activities because we're investing into the business. We're investing property, plant, and equipment into the business. So cash will come into the business for investing activities when we sell property, plant, or equipment. Cash will go out of the business when we purchase property, plant, or equipment. And those are all investing activities. And the third category on the statement of cash flows is called financing activities. Sometimes a company needs cash to fund a shortfall in cash, right? So I might take out a short-term loan to do that with. Or I need to finance the company by purchasing property, plant, and equipment using a loan. The loan is financing, right? Or we need to issue shares of stock to raise cash. I issue shares of stock, I receive the cash, that's financing activity. If I'm repurchasing shares of stock from shareholders, that's also a financing activity. We call that treasury stock. If I'm repaying a loan, that's a financing activity. If I'm buying or selling a bond, that's a financing activity, right? So financing activities represents the financing side of cash for the business. So those are the three primary categories. We'll talk more about them as we move forward in this conversation. Cash flow is super, super critical in business. You got to make sure you have enough cash on hand to operate the business, to pay your current debts, to pay your future debts. Uh, we got to know when we're receiving cash from our customers. It helps us as managers to make the right decisions. It's hard to run a business without cash. It's almost impossible. We need it for day-to-day operations. We also need it to make long-term investment decisions. So it's important that we as managers make sure that number one, we have enough cash on hand to operate the business and to pay our debts. And number two, that we have future cash flows in order to make investing decisions. So how do we measure the amount of cash coming into and out of the business? We do this using the statement of cash flows. So the way I like to explain this is that uh, we have cash coming into the business and out of the business for those three activities we talked about: operating, investing, and financing. Cash coming in minus the cash going out equals net cash flow, right? Cash that came in minus cash that went out is net cash flow. We do that for all three categories. That represents the total cash flow. That's how we measure cash flow. So as I mentioned, it's broken out into three categories: operating activities, that's the day-to-day operations of the business; investing activities, purchase or sale of property, plant, and equipment; financing activities, uh, loans, stocks, and bonds. So first, let's take a look at these operating activities. This is the cash that affects the business from operations. So cash coming into the business comes from the sales that we've made to our customers. Or maybe we're receiving some dividend revenue from our investments in other companies. We're collecting our accounts receivable. Maybe we're earning some interest revenue. These are all reasons why cash would come into the business for operating activities. You know, anytime you hear operating, they think day-to-day operations of the business. Reason why cash goes out of the business for operating activities: I got to pay my employees, I got to pay my accounts payable, I got to pay interest I owe, taxes I owe. All related to operations of the business. So cash coming in minus cash going out equals net cash flow for operating activities. For investing, we're talking about the purchase or sale of property, plant, and equipment. Think about it like this: we're investing into the business to grow the business. That's why we call them investing activities. The cash comes in from the sale of property, plant, and equipment. The cash goes out for the purchase of property, plant, and equipment. Very easy. Very, very easy. Then we have financing activities. Financing activities are ways that we finance the operation of the business. Remember, there's two ways we can finance the business. We can issue stock or issue debt, right? Take out a loan or issue stock. Those are two ways you got cash coming into the business for financing activities. I issue stock. I resell treasury stock. I take out a loan. Individual owners contribute money. Those are all financing activities, cash coming into the business. Cash goes out of the business. I'm paying dividends to my shareholders. I'm purchasing treasury stock. I'm paying off my loans or bonds. And when the owners take the money out of the business. Cash coming in minus cash going out equals net cash flow for financing activities. Those three slides I just showed you, these are probably my favorite three slides in this whole discussion because they really sum up exactly what's going on as it relates to cash and the statement of cash flows. Now, how is the statement of cash flows linked to the balance sheet and ultimately to the income statement? Think about it this way. It's linked to the income statement because net income is linked to the balance sheet as a form of retained earnings. That retained earnings can be used through cash to finance the business. Possibly, sure. So, but look at it this way. The way that we connect the balance sheet, there's a lot more connections between the balance sheet and the statement of cash flows. Your current assets, obviously cash is on there. That's operating cash flow. Accounts receivable, cash, accounts receivable. inventory, right? Those are all current assets. There's cash used either for all three of those, obviously. Current liabilities. I got to pay my accounts payables, wages payable, taxes payable, interest payable. All my current liabilities and current assets, all of those line items are directly related to operating cash. That makes sense because all my current assets and current liabilities are generated from my operations, right? And I need cash for my operation. Yeah. And we can also connect the balance sheet to the statement of cash flows through the assets and liabilities that are long term. So, long term assets, that's property, plant, and equipment, those are investing activities when I purchase or sell property, plant, or equipment. On the liability side, long term liabilities typically include bonds and notes payable, right? Those are directly related to financing. So that's how we connect the balance sheet to the statement of cash flows. It's also important to note that there are a couple of non-cash items as well that you would see. And these typically involve exchanges. We exchange one line item for another, basically. Here's a couple of basic examples of this. To pay off my debt, I issued stock to the debt holder. No cash was used there. I gave him stock instead of cash. Conversion of preferred stock to common stock. All I'm doing is exchanging one form of stock to another. No cash there. Uh, I'm leasing an asset in the form of a lease transaction. No cash there. I'm purchasing an asset by issuing a note or a bond. No cash involved. I'm exchanging non cash assets for other non cash assets. No cash involved. Purchase of a non cash asset by using equity or debt. Company purchases a piece of land, but instead of paying cash for that, they 100% finance it through a loan or they issue stock for it. Right? So these are examples of non cash investing and financing activities. So let me show you how we prepare that statement of cash flows and what it ultimately looks like using the direct method. And then I think I'm also going to show you the indirect method today as well. So the statement of cash flow reports on the cash from operating, investing, and financing activities, as we've discussed earlier. We take the cash that came in minus the cash that went out. For each of these areas, they get the net cash flow for each of these areas. So the cash that came in for operating activities minus the cash that went out for operating activities equals the net cash flow for operating activities. I do the same thing for investing and financing. Cash that came in minus the cash that went out for investing activities is the net cash flow for investing activities. Cash that came in minus the cash went out for financing activities is the net cash flow for financing activities. You see? Now we add or subtract them all up to get the net change in cash. Net change in cash. And then when I add or subtract the prior period balance of cash, I could get the current cash amount. And that should be pretty much the same as that last line item you see there. Cash equivalents, balance at the current period end is exactly what it's the same balance that you should see on your statement of cash flows for cash. All right. Let's walk through the 5 steps of preparing the statement of cash flows, first thing we do is we compute the change in cash, in total cash. Beginning balance minus ending balance, or ending balance minus beginning balance gives me the change in cash. We'll compute the cash we used for operating, investing, and financing activities. And then lastly, we would compute the change from all sources of cash. So in that first step, I need to analyze the cash account by looking at the change in cash. The cash that came in minus the cash that went out. I do that for the whole year to get my balance, my ending balance cash. Once I have my ending balance cash, I then need to analyze my non-cash accounts. If I needed to figure out what my cash balance is and I didn't have that amount at the ready, I can figure it out. I'm just going to take that cash to figure out how much cash I have. I'm going to take liabilities, total liabilities plus total equity, minus any non-cash assets. That's going to give you your cash balance. It's just like any other equation where you're trying to solve for the variable. The variable in this case is cash. So all we need to do is back everything out of that to figure out that balance. There's a couple of pieces of information, obviously, I need to gather to prepare the statement of cash flows. I need to be able to compare my balance sheets from the beginning and ending balances. So that way I can figure out what the difference is. Now I'll do simple horizontal analysis. Ending balance minus beginning balance gives me the change. I do that for every line item on the balance sheet. Well, definitely for my current assets and liabilities anyway. I need my most recent income statement that shows me what my ending balance net income, and maybe some additional pieces of information that would help me to better understand any non-cash transactions. So once I gather all that data together, I can then compute the statement of cash flows pretty easily. So there's two methods that we use when we compute the statement of cash flows. One's called the direct method, the other's called the indirect method. I'm going to show you what both of those look like. The direct method is the easiest method of computing your net cash by operating activities. And it's simple. We're just take the cash we receive from our customers minus the cash that we've paid for our operating activities, including interest and taxes. That gives you your net cash flow for operating activities. Very, very easy. But sometimes we don't always have all that data available, so we might need to compute what we call the indirect method. And in the indirect method, we take non-cash items and we find their differences. So we take our current assets and current liabilities from our balance sheets. We compute the differences to be able to figure out the increase or decrease in those accounts, which will then in turn tell us what our cash balance should be from operating activities. So if you look at the right-hand side of this slide, the indirect method looks like this and works like this. First thing we do is we need to find net income. We get that from the income statement. Okay, in this case, example, 38,000. Once we have that, the next thing we need to do is we need to calculate the changes in some of our asset accounts. So we look at our asset accounts and we look at the changes in them. First one we got depreciation expense. How do we find that? It's going to be the change in the book value of your equipment. Okay. Uh, like then of course minus any accumulated depreciation that was already there. Depreciation expense. We also get that from the income statement. And then we're going to add in loss from the sale of equipment and then subtract out the gain on retirement of bonds, those types of things. And we'd be able to see a lot of that from our balance sheet. And then the second part of that are the changes in the current assets and current liabilities. Changes in receivables, inventory, prepaid expenses, accounts payable, interest payable, income tax payable. Notice that all of those represent the operations, day-to-day operating activities. They just so happen to be current assets and liabilities. So we got our net income from the income statement, 38,000. We also got our depreciation expense from the income statement, 24,000. And what was the other one? Um, oh, we got the loss on the sale of equipment and the gain on the retirement of a bond or other gains and losses, also on the income statement. So we take those items from the income statement and the rest we're going to gather from the balance sheet. Now, to calculate the change on the balance sheet is pretty easy. We're going to take uh, our ending balance minus our beginning balance. So in this case, 27 minus 26 to get our difference here. Once we have our difference or change, we can then finish working on the indirect method of our statement of cash flows. So that first part again, we got from our income statement that these are items that do not affect cash. That's what we call the indirect method. Depreciation expense, gain or loss in the sale of equipment, gain or loss in the sale of retirement bonds, etc. And then we have the changes in current assets and liabilities. We add or subtract them based off of what's happening here from our net income to get our net cash flow provided by operating activities. In this example, 20,000. You'll notice that 20,000 is the same exact as if we were to do it using the direct method. And that's how you know you've done it correctly. There are a couple of things here to note. Going back to those non-cash activities. So the income statement includes expenses and losses that are subtracted when we compute the net income and not directly out of cash flows. These include things like depreciation, amortization, depletion, bad debt expense, loss from the asset of a sale, retirement of bonds and notes payable. When there are expenses and losses that do not affect cash, we use the indirect method to report on the statement of cash flows. And then we just simply adjust for them. Expenses and losses with no cash flows are added back into net income. Uh, and then, of course, the opposite is also true. So, in that example, we have our net income was 38,000. We had depreciation expense of 24. We're going to add that back into net income. Loss in the sale of equipment, we're going to add that back into net income. What we're subtracting out of net income is the gain on the retirement of the bond. So revenues and gains with no cash inflows are subtracted from net income. That's what that shows us. This is a nice little chart to show us next what the second step is what we would do as it relates to current assets and liabilities. We're looking for the change. If there's an increase in current assets, we subtract it from net income. If it's a decrease in current assets, we add it to net income. Uh, and then the opposite for current liabilities. The reason why it's opposite like that is you have to remember the accounting equation: assets equals liabilities plus equity. Once you reach the other side of that equals sign, the sign flips. Remember? So that's why it works that way. So we if decreases in current assets, we add them to net income. Increases in current assets are subtracted out. For current liabilities are added in. If it's a decrease, they're subtracted out. And that's what gives us that second part. I like this slide right here. This is a really nice summary of it. And this is honestly the best way to remember this indirect method of the statement of cash flows for operating activities is by trying to remember this slide. So we have our net income. We add in non-cash expenses or losses, subtract out non-cash revenues or gains, and we add in decreases in current assets, subtract out increases in current assets. We add in increases in current liabilities and subtract out decreases in current liabilities. Then you'll get the net cash flow provided by operating activities. I know that this is pretty complex stuff. Um, obviously the direct method is the easiest one, but it's also important to really understand the indirect method because you might be faced sometime with a question that says, "Hey, we're missing some of these variables, and the only way to be able to do it is going to be the indirect method." So that's why the indirect method exists. And then the rest of the saving of cash flows is real easy, especially when it comes to investing in financing activities, because we only rely really on cash for those. So there's no indirect component when it comes to investing in financing activities. All we're doing there is we're looking at changes in your fixed asset accounts. Your fixed assets are your property, plant, and equipment. We look at the changes. Those changes are reported for investing activities. So if we look at our example, our changes are in equipment and land. And so those changes in equipment and land would be what we would reflect on the investing activities. So, so here we can see an explanation of those changes, which are a direct result of accumulated depreciation and maybe the loss or gain of a sale on equipment. So all we need to do is we're calculating the difference between the beginning and ending balances. They make this look a lot more complicated than it really is. Um, they're just explaining that difference, but you really don't have to worry too much about that for this. And then for financing activities, again, we're really just looking at the changes in those long-term liability accounts. So long-term notes payable, bonds payable, etc. And we can see those changes reflected in the statement of cash flows. That's all you really need to know about this process. And this is really what it's explaining in a lot more detail than it needs to be, in my opinion. That's why I'm just breezing through these because, I mean, in reality, you're not going to need to go this deep when it comes to calculating those changes, because really we're just looking at the beginning balance or ending balance minus the beginning balance. That's going to give you your change. So, so the indirect method really only applies to the operating activities. Investing and financing activities, we're just going to use the direct method for those. All right. I had mentioned that in management, it's super critical that we understand that we have enough cash on hand and where that cash is going and how it's being used. And so as a manager, we do this in a couple of quick ways. And we look at a lot of ratios to show me, what my cash flows look like as they relate to the company's ability to do things like pay their current bills, pay any dividends, and their ability to expand in the future. So one ratio that we look at for that is called the cash flow on total assets ratio. And that cash flow on total assets ratio is calculated by taking your operating cash flows, so net being cash that came into the business minus the cash that went out of the business for operating activities gives you net cash flow for operating activities. We take that amount and we divide that by average total assets. So beginning balance plus ending balance divided by 2, average total assets. That gives us the cash flow on total assets ratio. And again, tells us about the company's ability to pay their current bills, pay dividends, expand operations, etc. So very good ratio to calculate. I will tell you that Excel is a super powerful tool that I'm sure you're well aware of. But we can prepare the statement of cash flows very simply using Excel. And we can also analyze the changes using Excel. And this really, it does help us to generate the direct and indirect methods of our statement of cash flows using Excel. So very, very useful tool. What else I want to show you? Oh, the direct method is so simple. The direct method, very, very simple. The cash that came in minus the cash that goes out equals net cash flow. Cash, and it's just really as simple as that. This just kind of shows you that those changes in cash and where the cash comes from and goes to. And that, my friends, is a nice abbreviated version of the statement of cash flows presentation, which leads us to our very last minute of class. So I just want to remind you of the 3 things that you have due, and I'd love you to do these by Sunday night if you can. I've given you a little bit of extra time because I recently found out that the semester ends on the 9th instead of the 6th, which I think it was originally. So the university decided to change the date for whatever reason. I don't know why, but they did. And I guess it's good for you. So 3 items you have to take care of. And I'd love for you to do that this weekend, just so that way it just saves you some headache from having to worry about it later. You have one remaining LinkedIn Learning activity, and that's your corporate financial statement analysis, LinkedIn Learning certificate. You have a quiz for chapter 15 and a quiz for chapter 16. So 3 action items. Recommend that you start them now so that we don't have to worry about them later. And just submit them as soon as you can. And then after that, I have a date here for the final exam, currently scheduled for the 11th. That's also open and available now. If you wanted to take the final exam early, you're more than welcome to do so as well. What I'll do for you is I'm going to I have a really nice short video that I did for the review for the final exam. I'm going to send that to you. I'll post it in the classroom. Recommend that you watch it. It'll make the final exam a lot easier for you, I promise. So those are my things for you. Again, this is the last time that we're meeting this semester. Um, so it's been my honor and pleasure to be able to work with all of you. I hope that some of you will be coming with me next semester, the second half of next semester. If you have the opportunity, I'm teaching Principles 2 in an 8-week format that starts in March. And it's on Monday nights, and I'm pretty sure that's going to be on campus. Um, Otherwise, I think Professor Chandler might also be teaching a section of Principles 2, which is a full 16 weeks. He's really good to work with as well. I think you'd like him as well. But either way, I hope that you continue with this. If this is your last accounting class, it was great working with you. But otherwise, either way, I wish you the best with the rest of your journey here at UDC, and hopefully I'll be able to work with you again in the near future. But I just want to say thank you to all of you. It's been an absolute pleasure and an honor to work with you. And if you ever need anything, even beyond this class, you need a letter of recommendation, you need a reference, you need a whatever's, feel free to reach out to me. Seriously, I want you to stay in touch. Also, if you want to connect with me on LinkedIn, I'm there. I'd love to catch up with all of you and see how your journey's going. So, but thank you all so much. Appreciate all of you. I hope you have a wonderful rest of your night.
Thank you.
Thank you all.
Thank you.
Take care, y'all. My pleasure. Bye-bye.
Bye.
Good night.